Now, normally I absolutely hate investing in restaurants, low margin business, very competitive, normally a good recipe for disaster. But there's this one restaurant that keeps popping up here. Now, in front of you is a mystery chart of a restaurant that I keep coming across, and now I'm finally going to dive into it. I don't know where the price is going to lead. I'm just going to take you through my analysis. We're going to start plugging in some numbers on this mystery company. We're going to go through the earnings, and then finally, we're going to get ideal stock price. Now we can see the current PE ratio sitting at 15.5 times. It's paying almost a 7% dividend, which I believe is actually in jeopardy. So I would not be surprised if this dividend gets slashed. The company you can see here is trading for under a $3 billion market cap. So you know it's in the restaurant business. You can see here by the chart, the 1-year chart, it's been a pretty ugly picture, down 23, nearly 24% in the last year, hitting a new 52-week low. And that's definitely something we've seen with consumer discretion, is a wide variety of outcomes, but it's very few companies that are executing at a high level. And I tend to think that this is one that's kind of going under the radar and being sold off, number one, with small caps, and number two, with the fact that it's in consumer discretion. But I tend to think that there is a competitive advantage to this company, and I actually think it's well positioned. One last hint, it is on this list of sales of selected leading quick service burger restaurant chains in the United States. And if you got one guess, put it in the comments now, because I'm going to tell you what stock we're talking about. We're talking about the company of the Junior Bacon Cheeseburger, the home of the Frosty, the one and only Wendy's. Now, as I stated, I normally hate restaurant businesses, but as we can see here, Wendy's is actually number 2 when it comes down to the quick service burger restaurant chains, obviously trailing the big monster of McDonald's for a $3 billion market cap. And when I go over exactly why this company's piquing my interest, I think you're going to see the value here as well. A couple things that have come out about Wendy's: they are actually partnered up with Palantir to run more efficient businesses. They're starting to lean more on technology and AI, as order services are done through automation, so that saves money in the long run on hiring extra personnel, and that allows the cooks inside just to be focused on one thing, and that's delivering a good burger. Now, once again, this is not a sexy name, but if you're new to the channel, I find value in different areas, definitely more contrarian than most. I like to look at things that are getting overlooked. When everybody's telling us to buy Microsoft, the contrarian thought process was maybe there's an Nvidia out there somewhere. And so when I think about McDonald's being the leader, I take a look at these types of underperformers that have some unique propositions underneath. Wendy's last quarter was not impressive, and I'm concerned about the dividend. And I think investors are concerned about the dividend as well. And I think that's a big reason why it's selling off. But this company brings value multiple ways. So first off, let's talk about this. They are still growing in the US. They're growing at 1.4%, obviously a little bit muted, but when you think about companies that are actually losing revenue, that are spending money, that are actually unsuccessful, we're still seeing growth here in a very tough market, especially when it comes down to more conscious consumers. We all know the GLP-1s are scaring a lot of businesses away, but we can see here that Wendy's is still showing some growth in the US. Internationally, they're growing at 8.3%, and globally, they're growing at 2.3%. So still some growth here on a pretty mature company. We can see that they only added one net store, and the reason being is that they are in a transition period. They are very, very focused on becoming more efficient. Any of their underperforming locations, they're closing shop, and they're opening up where locations should outperform. And so that's why we're only seeing a one net gain here. They're projected to add additional 250 to 300 globally locations here in the next year. So we're still going to see multiple locations opening up globally. As we see, international had a nice bump. And when we look at overall here, we went from 7,166 global locations to now nearly 7,300 global locations. They're projected to grow around 3%, and adjusted earnings are going to come anywhere from 99 cents to $1. Now, the problem with this is, as I stated, they're paying a quarterly dividend of 25 cents, which is not much left for the actual business. So this is where I see the problem longer term. They have to get those earnings raised up faster, especially with the fat dividend that they're currently paying. Now, adjusted EBITDA is going to come in at 535 to 545. And free cash flow is going to come in around $275 to $280 million. Now, I want you to think about this. Now, most restaurants have very, very slim operating margins. This is a company that's going to do around $2.5 billion in top line revenue, but take a look at how much free cash flow is coming through on this company. We're talking about over $275 million of free cash flow, which is over a 10% free cash flow yield. I'm going to use a flat growth rate of around 3% consistently over the next 10 years. I think this is something that's definitely achievable by the company. and maybe they can actually do better than that, but we're going to really just limit our expectations here. But we can see that it is steady top line revenue growth. So as the stock's getting cheaper, there's still growth within this company. We see them expanding internationally, and most forecasts have them between a $16 to about a $20 stock, some as high as $29 a share, and currently it's trading below $15 a share. We see that cash and cash equivalents are sitting right around $482 million, with restricted cash sitting at $35 million. And this is a company that does a tremendous amount of buybacks along with paying a dividend. Yes, they're growing top line revenue, but we're seeing earnings are actually contracting here. And this is going to be fairly normal with a lot of restaurant businesses. It's ebbs and flows, ups and downs, very hard to predict. And this is a big reason why I tend to stay away from them unless they present a pretty good opportunity. And so we're deciding if this is an opportunity right now. But there's multiple levers I like with this company. They obviously have top line sales, which were declining, but they were able to make up the difference with royalty fees going up, going from 444 million in royalty fees to now 458, call it 460 in royalty fees. They were basically able to offset weak sales with royalty fees. So they have multiple streams of income here. They have the top line sales, they have the franchise royalty fees, they have franchise rental income. So multiple streams of income for this franchise. And as I stated before, restaurants are not usually an area I like to be in, but when we take a look at their net income, it's over double to industry standard or sector median. So after plugging in my numbers using a 3% growth rate, you guys can see down here where I'm projecting revenue to possibly be in the future. The biggest concern I have with this valuation is a big part of my projections are based on if this dividend is going to be there or not, because we have to also include dividends as total returns. So if they can hold on to a 6 or 7% dividend and you believe they can grow earnings, so if you believe that this dividend is going to be safe, maybe you only need about a 5 to 6% rate of return from a capital appreciation standpoint and reinvesting that dividend, which means that between $12 and $13, this is definitely a buy. From a free cash flow standpoint, we could be looking at an $18 stock, which this was trading in the mid 20s recently. So definitely feasible to see it reapproach $18, $19 a share again. And that's probably where fair market value is for the company. It really comes down to, is this dividend safe? And I just don't know if this dividend is safe. So therefore, I think between a $10 to $12 ideal stock price is actually pretty interesting for Wendy's. Just for all sakes and purposes here, I do want to make it clear that they have paid a dividend for 21 consecutive years. So this is a company that's kind of been fiscally responsible. Right now, I think valuation is actually getting pretty compelling. I think if it got below 14 bucks a share, I definitely think this is a pretty interesting stock, because from a free cash flow standpoint, I definitely think we can be looking at $15, $16 a share. And if somehow they can hold on to that dividend, I think you have a nice compounder here. So Wendy's is pretty interesting. I like the fact they're growing internationally. I like the fact that they're very focused on relying more on technology to grow margins, free cash flows, and get more efficient on closing down shops that are underperforming, but opening up shops where they should outperform. So as always, guys, that was my quick dive into Wendy's. For me personally, I think between $12 and $13 is an interesting area. If somehow it got into a $10, $11 range, that's probably where I would be most interested. As always, appreciate your time, and we will see you all in the next one.